Hey, you guys, we have just two more pages of notes to finish for chapter 14. So this first section on page 7 is talking about disallowed losses. It's in section 267 in the Internal Revenue Code. You don't have to memorize the section number, but what I want you to do is work out this whole problem before looking at me, because we actually already did this exact same problem in chapter 6. So as you're working it out, remember that this is dealing with related taxpayers, and anytime you see a problem in tax with related taxpayers, throw up a caution sign and go, oh, probably we're going to be more strict and limited than in real life. You do need to read the book in this section because you need to know who a related party would be. But here is our problem we've worked before. And right now, I'm assuming you've already done this, and I'm just going to talk through a couple of things. Frank is the dad, Sam is the son. I first figured out Frank's realized loss, and he has a $5,000 realized loss because he sold it to his son for 10 grand and his basis was 15 grand. Because they are related parties, though, Frank does not get to recognize the loss. He really has one, but he can't report it on his tax return and save any taxes. Boo, that sucks for Frank. All right, what about Sam? Well, Frank never gets any relief from this, so he really doesn't want to sell it to his son unless he just has to. He'd rather sell it to somebody who's not a related party so that he could go ahead and recognize that loss. But whatever, he sold it to his son. What would his son Sam's basis be in the property? Well, whatever he paid for it, right? And Sam paid 10 grand for the land. There's no adjusted basis because we don't depreciate land. So we have three scenarios. If Sam later on sells it for 17 grand, he's got a $7,000 realized gain. If he sells it for a little less, a 2,000 realized gain, and even less, Sam's got a realized loss. The rules say Sam can use his dad's realized loss that his dad never got to recognize, but they can only use it up to the point where it would have Sam not go below zero as far as a recognized loss. So look, he gets to use all 5,000 of it here. That ends up with Sam recognizing only a $2,000 loss. Good for Sam. That helped him. Here, Sam can recognize only part of it because once he uses two of that 5,000, he's now at a zero recognized gain or loss. Using his dad's is not allowed to throw him into a loss or create more of a loss. So what happens to the other 3,000 of his dad's loss that he didn't use? It's gone forever. Another reason for his dad not to sell this stuff at a loss to a related party. And then in the third scenario, Sam was already at a realized loss, so he cannot use any of his dad's loss. And again, that just disappears forever. So look back, let me see if I can find it on page 5 of your notes. Remember in red, I have here text tip. Donors should not gift property that has a fair market value below the original cost. This is when we were dealing with a gift situation. And in that situation, it was because the loss will never be recognized. So same here, we want to advise our donor, well, not our donor in this case, sorry, our seller, Frank, hey, unless you really want this land to be in the hands of your son, and sometimes they do, right? It's family property. I don't care what the tax implications are. I want it to be in my son's hands. But otherwise, if you're just getting rid of it, sell it to a third party. Let Frank be allowed to recognize this loss, and then he'd still have 10 grand he could give his kid or sell something else to his kid or whatever. So just tax implications we need to be aware of. Okay, now we're going to move on to wash sales. Um, and if taxpayer sells stock for a loss, the loss cannot be recognized if, here's the verbiage they always use, if the taxpayer acquires substantially identical stock either 30 days before or 30 days after the sale. So look, the stock market is constantly going up and down. I was going to try to grab my stock market on my phone real quick and show you. The stock market is constantly going up and down for one reason or another. After Friday, yesterday, it dropped 280 points. And we've been doing this year, tons up and down and up and down. So here's a plan I have. Say I own a bunch of, let me find a stock that dropped a lot. Say I own a bunch of a particular stock that just happened to have a wild swing. Woo, Meta did. But I still really like Meta as a stock. Maybe I sell it. I take my loss, which means I can report it on my tax return, and that would reduce the amount of taxes I pay. And then I turn right back around and buy it again because I still like the stock and I think it's going to go up in the next couple of months. So this prevents us from doing that. And it's called taking like a paper loss. It means it wasn't really a loss after all. It was just a loss for a couple of days. So, all right, let's work a problem so you can kind of understand that more. Anna Grace owns 200 shares of red stock that she purchased for $20,000. That means she paid what? $100 per share of stock. I would go ahead and write that out. She then sells 100 shares for $8,000. So her selling price or her amount realized equals $8,000. Don't look at me real quick. You guys find the realized loss and you can stop there if you want to. So I hope you did this on your own because in class I make students do this and it's a really common error. It's not a rule you didn't know. It's just an easy, quick mistake. She only sold half of those shares for $8,000. And a common mistake I see students make is when they then find the adjusted basis of those shares, they come up here and grab 20,000 instead. But that was for all 200 shares. She only sold 100 of them. So the adjusted basis would be just 10,000. So her realized loss is $2,000. What is her recognized loss? We've got two things to think about here. Number one, that this is a capital asset and she cannot recognize more than 3,000 a year anyway. So if this had said like 12,000, we know she's limited to 3 just because it's capital asset. But also, this is a wash sale. Anna ends up buying the stock 29 days later after she sold it. So we're looking at these purchases either 30 days before or 30 days after. There's like a 61-day period there. So her recognized loss in this case is 0. She may not report this loss on her tax return, thereby saving her tax dollars this year. Do people do wash sales? All the freaking time. If you are in public accounting and you get a 1099, which reports the sale of stock, it'll have a W next to the sale, and you'll enter that into Lacert or whatever tax program you're using, and that'll tell the program, hey, we can't take this loss. So then what happens to that? Remember up here, it was gone forever. Well, in this situation, it's not gone forever. What we do, and I'll work on this a lot more with you later, this will kind of be your first introduction to this, but what we do is we adjust the basis in her newly acquired shares. So without knowing any new rules, what is her basis in the newly acquired 100 shares of stock? It would be 6 grand what she paid for it, right? If you guys buy some Apple stock today, your basis is just what you paid for that stock. So original cost. But because she was not allowed to recognize this 2,000, there's a little formula that says, hey, add that basis, add to your basis what you were not allowed to recognize. And she now has an $8,000 basis in the new stock. Why? Let me show you. 29 days later, she purchased this. This is the new 100 shares. Say the very next day, Anna Grace says, you know what? I don't want this stock after all. I'm done. Forget it. I'm not buying it ever again. I want to sell it. How much do you think Anna Grace would sell it for? Well, probably $6,000 if it's the very next morning, right? Say this was on close of business day, the 29th day, and the 30th day she sold it. She would sell it for whatever it's worth, $6,000. So, okay, sell one day later. She would sell it for 6,000, what it's worth. I'm gonna say fair market value. Now watch though, even though she paid 6,000 for it, we're going to say her basis in this stock is actually 8,000, giving her a $2,000 loss that now she can recognize. So with a wash sale, we're just postponing this loss. It is not gone forever. But with related parties, the loss is gone forever. With the gift situation where somebody gave property, gift property at a loss, the loss is gone forever. So that's also why I like flashcards to learn these rules, because when you get to a test or a real life situation, they just get all mixed up in your brain. But with flashcards, you can kind of lay them out side by side and look at each one and notice the differences more easily and go, oh yeah, on a wash sale, we can carry that loss over, but we cannot on this, those kinds of things. Okay, so now let's flip over to our very last page. And our final section will be on property converted from personal use to business use. So, as an example, I have a rent house that I used to live in when I first moved back to Tyler. We built this house out in Flint, and we built it with the intention of, hey, we're going to live here a little while, and then this will be a perfect rent house. We'll just keep it. So I lived there, I can't remember, I think 2 years. And then when I moved into Tyler, I kept that house as a rent house. So my question becomes, what is my basis to use on that house as rental property? Or even after I sell it and it's been rental property, what is my basis for selling it? Because I had converted it from personal use to business use. So here are our set of rules. And again, we'll go a little bit more into detail than we did when you guys covered this in chapter 8, your depreciation chapter. So I've got two kind of sets of rules here, and I would picture these as two flashcards, okay? So one is if the fair market value at the date of conversion, the day I make it business property, is greater than the basis. So that makes it appreciated property, right? I think of that like real estate. Usually it has appreciated. That little rent house I bought in Flint has appreciated. So use the adjusted basis on the date of the conversion. But if the fair market value at the date of the conversion is less than the basis, so now my rent house is in Detroit, or more likely this is like, personal property, equipment or a car or something, then we've got one of those dual bases to look at, a loss basis or a gain basis. Your loss basis, we're going to go to fair market value on date of conversion, and your gain, we're looking at adjusted basis. So again, as you're working these problems, I would write out your rule and then place the number in beside it. The more you do that in your notes and on your homework and then on your test, the less likely you are to just grab an incorrect number. But let's talk about why and look at some examples, and this is going to help it stick in your head better. So Olga owns a boat that costs $2,000 and is used for personal enjoyment. That means she is not depreciating that boat, right? It also means if Olga sells it for a loss, she cannot take the loss. I'm trying to think. Let me look back. Didn't we start our notes in this chapter with a personal loss? Yeah. Remember on page 3 of your notes, we looked at personal stuff where Taylor was selling a Highlander. Even if she really has a loss, she cannot recognize it because the tax law says we cannot recognize losses on personal use property. So that's what's going on here with Olga. Today, the boat has a $1,400 fair market value. If she sells that boat today, she would have a $600 realized loss, right? But what about her recognized loss? Zero. And again, write your rules down. Why? Where did we come up with these numbers from? Because no losses allowed on personal use property. Okay, so Olga has this genius idea. I know what. Instead of selling this boat that I've been using personally, I will transfer the boat to my business of operating a marina. That's her business. She has a little marina out at the lake. She's going to transfer it to the business. You know what businesses can do? Businesses are allowed to recognize losses, right? Personal not, businesses, yes. So Olga thinks she's being sneaky. So Olga says this, it normally in her business, if you sold something for 1,400 that had a 2,000 adjusted basis, you could recognize that loss. But let's apply these rules since this is property that was converted from personal to business use. we go up here and we say, if the fair market value on the date of the conversion is less than basis, it is here, 1,400, and a label. 1,400 is less than 2,000. Then if we sell at a loss, the basis in the business is going to be whatever the fair market value is at date of conversion. So I'm going to write those rules down. Use fair market value at date of conversion. And I'm going to look up here and I'm going to go, is it this? Nope, that says adjusted basis. Is it this? Yes. 1,400. So now the business sells it for 1,400. And the business's basis is 1,400. What does the business get to recognize? 0. So that's the why of this. That's what's going to help you remember the rules and later help yourself and your clients and your business you own or whatever use these to your advantage. It doesn't help you any, and the rules are there in place, not just to be confusing, but they're there for a reason. Hey, if we don't allow you to take this loss personally, Olga, then we're not going to let you transfer that to your business just to take the loss. Whatever loss was incurred while you held it personally, you will never be able to take as a business. And that's just kind of what I'm explaining there. So same for depreciation. If this rule were not in place, even if Olga didn't want to sell it, she just transferred it to the marina and said, hey, I'll just depreciate $2,000. Those are real deductions that save Olga money, right? But this rule says, no, we're not going to let Olga depreciate all 2,000 of it. We're only going to let her depreciate 1,400 of it. Okay, let's look at scenario 2. What if the boat's value had actually appreciated and the fair market value at the time of the conversion was 2,500? Stop, write your rule down, and fill in the blanks there, and then come back here. So now fair market value at date of conversion is greater than basis. Then we'll use the adjusted basis on the date of conversion. So adjusted basis on date of conversion is $2,000. So not 2,500, her adjusted basis on date of conversion, we're going to use $2,000. And if she wants to depreciate it, that makes sense, y'all, that she's only going to get to depreciate 2,000 of this thing and not 2,500. She didn't really pay that for it. So again, playing around with some examples in the book and writing it out and writing your rules out is the way for this to stick in your head, okay? And down here, I'm just talking about why does this exist and explaining what I just talked about. As always, I know y'all are tired of reading, but it just comes down to, do you want to learn this? Do you want to do well on the test? And to me, even more importantly, like, this is your career. Do you really want to get this? Be sure to read the tax planning section. Okay, that's it for that chapter.